Good morning and welcome to Capital Sound. Futures are softer on an oil dip, but are we really trading crude or are we trading a market that can't handle its own size? I am Mandy Prince, and with me today is Franklin Pierce.
Good morning, Mandy. Glad to be here.
Quick snapshot before we dig in. Major indexes are lower in early trading, with tech under more pressure than the broad market. Volatility is a touch higher, but not in anything like crisis territory. Energy is leading the move lower, defensives are steadier, and yields have nudged up. That is the surface. The real question is, what is underneath? So let me start with the hook. Futures are down on oil. Are we really trading crude or are we trading a market that can't handle its own size?
I hear two stories living on top of each other. First, this isn't a weather squall. It is a climate shift for inflation, energy and labor together can keep policy tighter longer, which compresses valuation multiples. Second, market plumbing is thin. When liquidity is poor, any shock feels larger. That is how you get oversized moves that don't cleanly map to the headline.
Okay, let me translate that for listeners. You are saying oil and jobs are pushing inflation higher, which pressures stocks, and separately, there is less willingness to absorb trades. So prices swing more than the news alone would justify. Is that fair?
That is exactly it. The fundamentals are the anchor and the microstructure is the magnifier.
I want to press on the fundamentals first. If we're in higher for longer, are you saying the sell-off is justified, or is this mostly a liquidity story that would gap even if oil weren't the headline?
The logic first, when labor stays tight and energy costs reaccelerate, the central bank has less room to ease. That tightens financial conditions and forces equity investors to pay less for the same growth. So yes, a repricing makes sense. The conclusion is that the sell-off is fundamentally supported, but the speed and the jaggedness, that is mechanics.
That is a strong claim. Most people hear oil dip and think this is just a moment. Walk me through why you are confident it is more than that.
From what I am hearing on the ground, talking to customers and suppliers across energy-intensive industries, companies are planning for higher input costs to persist, not vanish. That aligns with public statements we've seen about pricing and pass-through, in my experience. When management teams begin to bake in higher costs for multiple quarters, it tends to stick. That is the climate shift I am pointing to.
You just used microstructure. Hold on, let me make sure our listeners are with us. When you say microstructure, you mean how the market actually functions, right? Like who is available to buy when someone wants to sell?
Exactly, it is the market's plumbing when dealers step back or liquidity is thin. Even moderate sell programs can create air pockets. The market is trading like a weekend crypto book, one big order away from a cascade.
That image is vivid, but also a bit scary. Are you saying today's drop is more about fragile plumbing than fundamentals?
I wouldn't separate them that cleanly. Think of it like weather and terrain. The weather is inflation pressure, the terrain is liquidity. Put rain on a steep slope, you get a slide, put that same rain on flat ground. Maybe not right now, we've got the slope.
Let's keep that tension going. What are the concrete signs that dealers are stepping back, and how does that change risk for someone just trying to manage a portfolio without being glued to the screen?
The logic is simple. When intraday moves widen and the bid-ask spreads feel jumpier, you are seeing less willingness to take the other side from conversations across the supply chain of market makers. Not insider info, just broadly observable behavior. You see a preference to reduce inventory. That means lower depth. The conclusion is that intraday swings can be exaggerated, even if the news isn't extraordinary.
So in plain English, fewer buyers and sellers willing to absorb trades, which means price swings can be bigger. For listeners, that is, don't be surprised if it whips around, right?
That is right, and it also argues for patience. In this kind of tape, speed isn't necessarily an advantage. The biggest risk isn't being wrong, it is being overexposed to being wrong when liquidity thins.
I want to push back a little. If the fundamentals are really shifting, isn't the message to reassess growth expectations rather than focus on market plumbing?
It is a fair challenge. The core assessment should be business quality. The reason I keep circling back to liquidity is because it affects how your thesis gets tested. In 2022, we saw how rate shocks created rapid repricing. Many great businesses were dragged down in the short run. You had to distinguish temporary price pressure from permanent business impairment. Liquidity issues muddy that signal.
That is helpful. So you are saying keep your eyes on business quality, but recognize that price action can be a distorted mirror in the short term.
Exactly.
Let's shift to the surprise angle because this is the part that caught my attention. What if the real tail risk isn't direction? It is function. Could good news still produce ugly tape?
The real tail risk isn't direction. It is market functioning. Good news can still produce ugly tape. If dealers are thin and investors are trying to reduce exposure, even a benign report can be used as an exit window. That doesn't mean the business backdrop is collapsing. It means the market is prioritizing balance sheet and risk limits over fundamental news.
That is a big statement. I hear you, but aren't you overstating the plumbing risk? People would say, if the jobs data is fine and oil calms down, markets should stabilize.
Stabilization is possible, and I'd welcome it, but if structural inflation pressure remains, policy stays tighter, and liquidity remains scarce, stabilization doesn't automatically equal smooth. The conclusion is that even good news can create a volatile response as portfolios rebalance.
Okay, you brought up labor and energy. Let's go to the day's catalyst, the jobs report. What is the threshold that flips the central bank from patient to persistent?
I wouldn't tie it to a specific number. The logic is direction and persistence. If job growth and wage pressure continue to look firm, the central bank has less room to ease. The conclusion is that strong labor is bad news for rates, even if it feels good for the real economy.
So, strong labor can be bad news is the headline that is counterintuitive. For listeners, good jobs data can mean higher rates for longer, which can weigh on stock valuations.
Precisely.
You also said even a benign print won't fix liquidity. Why not?
Because liquidity is more about balance sheet constraints and risk appetite than one data point. If dealers are already cautious, it takes time for that to normalize. A single report won't rebuild depth. That is why I keep highlighting mechanical air pockets.
You mentioned the yen and global spillovers in your notes. How does that fit in?
I observed that currency stress can amplify risk-off moves. If the yen weakens further and intervention risk rises, that can tighten global liquidity. It is a second-order effect, but it matters, especially when energy prices are a component of inflation. Think of it as another constraint on risk-taking.
Translate that if the yen gets pressured and policymakers respond, global money flows can tighten, which makes markets more fragile. Is that right?
Yes, it is cross-asset linkages, and that is why I am cautious, even if today's news looks manageable.
I want to make sure listeners hear your growth lens. You are a long-term growth investor. How does that mindset operate in a tape that feels this jumpy?
The logic is that outstanding businesses compound, even when the tape is noisy. The conclusion is not to chase every move, but to evaluate management quality and R&D effectiveness. If a company is still investing through uncertainty, that is a signal patience with quality holdings typically rewards.
Give me a practical framework without crossing into advice. What should listeners do with that?
Think in layers. First, confirm the business model hasn't been impaired. Second, ask whether management is responding with long-term discipline, not short-term cosmetic fixes. Third, accept that the market's short-term mood can be harsh. If you are confident in the first two, the third becomes a test of temperament, not thesis.
That is grounding, but you did say liquidity can create air pockets. How does someone avoid getting shaken out at the wrong time?
I can't tell anyone what to do with their portfolio. I can say that in volatile environments, reducing the number of decisions you make is itself a strategy. If you try to trade every swing, you invite error. That is a lesson I learned the hard way in 2020.
That is the kind of honesty people need to hear. Let's circle back to the contested thesis. Is today's move fundamentally justified or mechanically amplified? You've argued both. If you had to weigh them, where do you land?
I'd put more weight on fundamentals because inflation pressure and firm labor can persist, but the magnitude of the move and the ugliness of the tape are disproportionately mechanical. So the fundamentals explain direction, the mechanics explain speed and severity.
And if someone disagrees and says, this is just a liquidity story, what would you say?
I'd say they're missing the inflation regime. Liquidity alone doesn't compress valuations for quarters, it just moves prices faster. The deeper anchor is policy and inflation.
Okay, let's do a quick scenario framework without turning this into fortune telling. Give us two paths. What happens if the jobs report is strong and oil stays elevated? And what happens if the report is cooler and energy softens?
Path 1, if labor is firm and energy remains pressured, I'd expect tighter financial conditions to persist and equity multiples to stay under pressure. The signal to watch is whether credit spreads widen and risk appetite stays subdued. Path 2, if labor cools and energy eases, I'd expect some stabilization in broader markets. But still choppy trading because liquidity doesn't heal overnight. The signal there is whether intraday volatility narrows and sector leadership broadens beyond defensives.
Which path do you think is more likely?
I lean toward the first, but I am watching for evidence. If management teams start signaling cost relief and forward demand stability, I'll recalibrate.
Let's make this accessible again. You are saying strong jobs plus stubborn energy means tighter conditions and watch credit stress. If the data cools, it helps, but we should still expect volatility until the market's plumbing improves.
That is a clean summary.
I want to bring in one of your core disciplines, management quality, in this environment. What separates a great management team from a good one?
The logic is transparency and long-term allocation. Great teams communicate clearly about cost pressures and continue funding R&D in a disciplined way. They don't sacrifice the future for a prettier quarter. The conclusion is that the best managed businesses show their character during uncertain periods.
Any signs you look for in those calls or investor updates?
I listen for consistency and humility. If a team can say, we're seeing pressure here, but our roadmap stays intact, and then follow through, that matters. I also look at how they talk about customers, not just margins.
That is the kind of qualitative filter people can use.
It is not flashy, but it works.
We're nearing the end, so I want to do our one takeaway moment. If listeners remember just one thing from tonight, what should it be?
In a market like this, the business is the compass, the tape is just the weather.
Simple and strong. Before we wrap, any final human note? A moment from your past that helps frame this.
In the 2022 rate shock, I saw excellent companies get marked down as if their futures had changed. Most of them hadn't. The lesson was to separate transient price stress from permanent business impairment.
That is a good bridge to where we are now. Let's close with a watch list. If you are listening this morning, here are the 3 things to watch. 1, the jobs report tone, cooling versus firm. 2, energy prices, and whether the pullback sticks or snaps back. 3, signs of market functioning. Are intraday swings narrowing or staying jumpy, Franklin? Add 1 thing you are watching.
I am watching the yen, and any signal that currency stress is tightening global liquidity. It is a quiet risk amplifier.
And 1 more.
I am also watching management commentary from energy-intensive industries. It is an early read on how persistent they think cost pressure is.
That is a full list. Franklin, thanks for the thoughtful framework today.
Always a pleasure. Mandy, keep your eyes on business quality and your hands steady.
Thanks for listening to Capital Sound. We'll be back tomorrow with a fresh read on the markets. Have a great trading day and goodbye.